Educational report, The Influence of Central Banks on Money Creation and Its Global Impact. Introduction to Central Banking and Money Creation. Understanding where money comes from and who controls it is a crucial question that rarely receives the attention it deserves. While it may seem like the government is responsible for issuing currency, the reality is much more complex. In this report, we will explore the central banking system, its historical roots, and its control over the global economy. The purpose is to reveal how central banks, such as the Federal Reserve, exercise substantial influence over money creation, inflation, and economic stability. Footnote: the control of money issuance has far-reaching effects on global economies and is central to understanding financial systems today. The birth of central banking. The origins of modern central banking can be traced back to 1694 with the establishment of the Bank of England. At the time, England was recovering from years of war, and the government needed loans to fund its operations. The Bank of England was the first privately owned bank authorized to issue money on behalf of the government. This marked the beginning of central banking as we know it today, where a small group of individuals or corporations control the creation of money. This system, despite its power, remains largely hidden from the general public, as it operates behind the scenes. Footnote: the Bank of England's establishment in 1694 marks the beginning of central banking, where money creation was entrusted to private entities. The formation of the Federal Reserve System. Fast forward to 1910, when a group of influential bankers secretly met on Jekyll Island, Georgia, to create the Federal Reserve System. This meeting was not publicized, and the bill that resulted from it, the Federal Reserve Act, was passed in December 1913 under the guise of stabilizing the economy and curbing the power of Wall Street banks. However, the truth was that the very same bankers who were accused of monopolizing the financial system were the ones behind the creation of the Federal Reserve. The Federal Reserve's ability to create money from nothing gives it unmatched control over the U.S. economy and, by extension, the global financial system. Footnote: the Federal Reserve was secretly formed in 1910 by a group of bankers to centralize money creation and gain control over the U.S. economy. The Federal Reserve's power over the economy. Today, the Federal Reserve is one of the most powerful institutions in the world. As an independent agency, it can influence the economy through various tools, including adjusting interest rates and controlling the money supply. The Federal Reserve's actions can create economic booms or busts, affecting everything from housing markets to employment rates. The central bank's power is so vast that it is often not held accountable to the general public or government oversight. This lack of transparency and accountability contributes to systemic economic inequality and financial instability. Footnote: the Federal Reserve's ability to control the money supply and interest rates allows it to steer the economy, but it operates without sufficient public accountability. The global impact of the U.S. dollar. Since the end of World War II, the U.S. dollar has served as the global reserve currency. This means that central banks around the world hold U.S. dollars in their reserves to back their own currencies. Consequently, U.S. monetary policy directly affects the global economy. When the Federal Reserve creates more money, it dilutes the value of the dollar, which, in turn, impacts every other currency tied to it. Countries like Russia and China have responded to this by reducing their U.S. dollar holdings and increasing their gold reserves, signaling their desire to move away from a system controlled by the Federal Reserve. Footnote: the U.S. dollar's status as the global reserve currency means that U.S. monetary policy has far-reaching effects on global economies. The concept of fiat currency. The term fiat currency refers to money that is not backed by a physical commodity, such as gold. Instead, it derives its value from the trust and faith that people have in the government that issues it. Since 1971, the U.S. dollar has been a fiat currency, meaning it is no longer backed by gold. The Federal Reserve creates money out of thin air by writing checks or electronically creating funds that can be used for government spending. This process of money creation, while legal, has far-reaching consequences, including inflation and the devaluation of the currency. Footnote: Fiat currency is not backed by a tangible asset like gold, and its value relies solely on public trust in the issuing government. The role of debt in the economic system. Under the current monetary system, debt is a key component of money creation. Commercial banks create money by issuing loans, and these loans are recorded as assets on the bank's balance sheet. This system, known as fractional reserve lending, allows banks to lend out more money than they have in reserves, effectively creating money out of nothing. Debt, therefore, is a necessary part of the economy, and the growth of debt is directly tied to the expansion of the money supply. This creates a system where more and more money must be borrowed and repaid, leading to an ever-increasing debt burden. Footnote: The modern economic system relies on the continuous growth of debt to maintain the money supply, leading to systemic debt accumulation. Inflation and the consequences of money printing. One of the main consequences of money creation by central banks is inflation. As more money is created, the value of each individual unit of currency decreases, leading to higher prices for goods and services. This process is often referred to as a hidden tax because it erodes the purchasing power of people's savings and income. Inflation disproportionately affects those who hold the least wealth, as the value of their money decreases while the cost of living rises. This system of money creation and inflation has been in place for decades, but it has resulted in wealth inequality and economic instability. Footnote: Inflation is a direct consequence of money creation by central banks, leading to a loss of purchasing power for everyday consumers. The future of money, cryptocurrencies and the rejection of debt. In response to the growing concerns over the debt-based monetary system, cryptocurrencies like Bitcoin have emerged as an alternative. Cryptocurrencies offer a decentralized, digital form of money that is not controlled by central banks. As more people reject the traditional financial system, cryptocurrencies have gained popularity as a hedge against inflation and a store of value. However, the rise of cryptocurrencies also poses challenges to governments and central banks that rely on their control over the money supply. Footnote: Cryptocurrencies like Bitcoin offer an alternative to the traditional debt-based monetary system, providing a decentralized form of money.